Good evening. Thanks for visiting our website, and now I prepare another short video with one topic that I feel very interesting for the business community. This topic called is debt restructuring. I believe that during the business life of the company that they have to really sit down with the creditor to come up with one solution how to make it possible for the company to make the payment to service the debt during the term of the loan. And of course, a lot of questions come up with how to book this transaction, or how to international financial reporting standard view this transaction. Okay, so the subject of this topic is the debt restructuring. Okay, and we have two parties here. First is the lender or the creditor, and then we have here the debitor or the borrower. In this case, the company. Okay. So in the normal transaction, the lender or creditor will send the money to the borrower, and then during the life of the loan agreement, the borrower have to service two things: the interest, and at the end of the loan terms, they have to pay the principal. This scheme is normally known as a bullet payment. Okay, but of course the debitor, because they are in the business, and in the real business, there's a lot of uncertainties. They can face what we call the financial problem, or difficulties, or they have a financial trouble, or they can call it a hardship. So all this squeeze the financial condition of the company. They can come from this, the source of this problem can come from the external, or can come from the internal. Okay, from the external, the market situation, the government regulation, could be come from competition in the market, could come from the substitute of your product, and many things. And from the internal, of course, it can come from the management problem, come from your organization. This includes your employees' capability. It could come from your production, from your supply chain, from your marketing strategy, and I could list a lot of things about this. So all these external factor and internal factor give a pressure to your financial, or contribute to your financial problem. So as a borrower, you have no choice. You have to service your interest and your principal. Okay, so you come to your creditor or your lender, you sit down with them, and you try to negotiate. So negotiate, renegotiate. So you have to negotiate your original or your existing loan agreement, the terms of your agreement. So this you come up with either you can do you modify. So basically you try to modify the terms of your agreement with the bank. And when I say the modify, there's two things that you can do with them. First, you modify of course, you modify the terms of your loan agreement. Okay, the terms of your loan agreement. Okay, but I go back a bit to here, because when you have your financial problem and difficulties, basically you can see that this is where there is a short term, where there is a long term problem. So your financial situation, you can see whether this is just a short term because of the business ups and downs, and whether it's a long term problem. So it's a short term problem. For example, one of your biggest customer cannot meet the obligation to pay the invoice in the due time, and that's why you don't have the enough money to pay the interest when it's fall due. Then you try to negotiate with the bank to extend the payment of the interest to for example, to the next quarter. So this is what we call short term. But when we talk about the debt restructuring, the modification of the terms of the agreement, I'm talking about the long-term situation. So basically, this is a permanent solution, permanent change in the terms of your agreement. Why bank agreed to sit down with you to talk about something long-term modification of the terms of the agreement? As we know that the cost of default for the bank is higher than the cost of loan modification. So this is, as long as the business is viable and there's a prospect and the asset also can make a contribution to the business, definitely bank wants to sit down with you. And that's why we come up with the loan modification. So when I refer the loan modification or debt restructuring as a long-term or permanent change in the terms of the agreement. So this is the permanent change in the terms of the agreement. Okay, so it's a permanent change. If it's a short term, usually we call forbearance agreement. Okay, so it's a permanent change in the terms of the agreement. And then, of course, there's a purpose. The objective of this is to make it possible. So you have to come up with one level of loan that make it possible for the company, the business of the company can afford to pay to service the loan in terms of the interest and also the principal. So this is the purpose, is to make it the business effort to pay to the bank, to pay back to the bank. Okay, so this is a brief background about the loan modification. In the next video, I'm going to explain what the International Financial Reporting Standard has the view over the loan modification and including the extinguishment of the loan. Okay, see you in the next video. Bye-bye.